Okay, the session has commenced recording. It's January 16, 2025. I'm Tim Quast. Thank you for joining the weekly live Edge demo and discussion. I call it both. We don't really demo the product per se. We talk about how to use it. That's the principal aim here. And along with me is Brian Wilson, market strategist, and we'll each cover. We'll aim. We try to be done by 1:10. No later than that, Mountain Time, 3:10 Eastern Time, so that we give you the rest of the day to use productively. There, you can only take so much market structure at a time. So anyway, good to see. I see some familiar faces and I see some names I don't know. So thank you for being here if you haven't come before. So with that, let me hand the meeting over to Brian Wilson. Brian.
Terrific. Thanks, Tim. Once again, great to see everyone. As Tim mentioned, good to see some new people here on the call today. We appreciate that. We do appreciate your input, your questions. They're all welcome because we're learning just like you are. We've been doing this a long time, but there's always new things to learn, and that's part of what makes trading interesting and trading exciting. In terms of what I'm going to cover, I'm actually going to cover a few of the what I call big portfolios. I mentioned one of them in the market desk note this morning, and here's what I mean by big portfolios. I'll start with energy, which is what I mentioned in this morning's note. So what I do is I take the sectors and I divide them up into smaller components. And the way that I do that, just click on the sector and it'll come up. And once it comes up, and what I do is just sort that by market cap. And so just find a convenient cutoff, whatever that might be. Usually I'll take like the top 10 or 12, something like that. The reason that I do that is the larger the number, the more things get smoothed out a little bit. So it just gives me an idea what the big players are doing. And a lot of times those big players will then move the market, sometimes a little bit more. And we'll shift back to energy. I mentioned this, I believe, in the last market, I believe last week, but I mentioned it in the market desk note this morning as well. But it's good to see what's happening here, and especially at inflection points. So here's the big companies in terms of energy companies, and I believe this is like top 10. Yeah, top 10. What I wanted to show you was what was occurring coming into expirations, and this was in the desk note this morning. You can see everything was very, very oversold coming into expirations, and expirations itself served as an inflection point. And let me show you what this inflection point looks like. We'll move to utilities here in just a moment. It's actually a similar story. But look at the 6 month chart for energy, and this is also a great example. Couple of examples here, but look at inflection points here. Energy lower into the end of the month. When did energy catch a bid? A new month. So natural inflection point, month to month transitions, also options expiration. So energy catches a bid at the beginning of a new month. Where does energy start to move lower? Well, that was right during November options expirations. The air came out of the sector all the way into December options expirations, and then it caught a bid again. For some of the small cap companies that I track, this was like 25% appreciation. So it was not insignificant by any stretch of the imagination. But you can see the natural inflection points here. Once again, month end, November expirations, December expirations, and you're able to capture that pretty well just by looking at the big companies, looking how oversold they were, and looking at the short covering that was occurring at the same time. So that was big energy. Let me show you what was happening in our big financials. Very interesting coming into really I'll call it the unofficial beginning of earnings season here. And take a peek at what was happening here. So here's the big financials. So we had BlackRock, Citigroup, JP Morgan, Wells Fargo. I'm probably missing a few. Sentiment neutral. I'd love for it to be higher, but look at what was happening to short volume coming into reporting season. Everything was getting covered. It was a bullish signal coming into this unofficial beginning of earnings season, and we saw the result yesterday with the financials taking off, and that was part of the reason that the broad market was able to move higher as well. But it was very evident when you look at those companies how market participants were leaning coming into this earnings season. One other example from the what I call the big portfolios, and I actually just noticed this one today. I previously did not have one set up for the utilities because they're only about 2% of the S&P 500. So it's not meaningful in terms of the percentage, but in terms of what was happening in the utilities, very, very similar to what was happening in the energy stocks. Look at utilities just getting totally washed out coming into December options expirations, but shorts had been covered. And you see the rally in demand from that point going forward. And take a look at recent short covering as well. Let me show you what that looks like. These are the spiders, by the way, what I'm pulling up here. So this is the spider for the utilities. Once again, inflection point trading, that's the end of a month. We come into December options expirations, not as much of a rally as the energy sector, but look at that recent rally straight up. And that coincided with what we saw right there, just very sharp short covering. So, just a good illustration of how, even from a sector perspective, things can be very predictive when we look at the edge data. Tim, I think I'll cover a little bit of the ahead, and then I'll let you kind of move into that section as well. As I
Sure, we can
look at
tag team that a little bit.
Okay,
Yeah.
perfect. As I look at what's ahead, I mentioned in the note this morning, it's a tough read right now. Here's what we're seeing in terms of daily sentiment. So this is a daily number, just a slight decrease right now. So sentiment just very slowly starting to move lower at a natural inflection point. But if you look at the 5-day number, 5-day average, right stuck at 5. So sentiment just very, very slowly starting to move lower. But look at what's happened to short volume. This was a 10% increase from early December going up to our peak just a couple of days ago. Short volume now just starting to move lower. You can make an argument that, either way, really, that here's our neutral state, 5 out of 10. Does sentiment move lower coming out of expirations? If so, that would obviously be difficult for the broad market. But what happens if short volume now starts to move lower? That was such an extreme move higher. The next logical thing to happen would be short covering from this point forward. Usually short covering is constructive for the market. Here's one other argument in favor of constructive tendencies. Look at the number of names in momentum, number of names in low volatility. When you get this many names, usually it's generally pretty good for the market. At the very least, it gives us a lot of opportunities, right? A lot of choices that you can trade. But central tendency, usually the higher the number of names you have, the better chance that the broad market has, to move higher. So with that, I think I will stop, Tim. I think that's the things that I wanted to cover.
Okay, thank you very much, Brian. Yeah,
Mhm.
it's a topic of considerable internal debate. And John Cook, I don't know if you're here. John, he's a data geek, perhaps as big a data geek as me, maybe bigger. And he shares views all the time. And I think he does a really good job of looking at the data. But one of the things we've been talking about is does the market go up or down? I mean, it's the central question. It's just that's the whole point. We want to know which direction prices are likely to move. And here, I'll share my screen. Uh, I'll tell you what has made it, and it's been challenging, and here's why. If you look at broad sentiment, I'm just going to pick up where Brian left off, and you could pick any time. You could go back and look at what happened during a boom stretch. I'm just going to do this. So we go back 3 years. I'll show you where it's really easy. Where is it really easy to know which direction the market's going to go? Well, here, when the Fed changed monetary policy in around October 30, might have even been. It was, I remember because October 31st is my birthday, and we were in Aspen at the time, as I recall. And you could look at so broad sentiment bottomed, and supply was declining. So you get a lot of green like that. That's really going to juice the market. Man, that's a piece of cake. You can buy everything in the momentum portfolio and put a little stop on it and let it run. It's just an awesome time. These are, this is more challenging when you have where you have sentiment drop, but it doesn't bottom, and then it rises and it just gets to the red line, and you see a big spike on the supply side. Well, that probably means stocks will decline. Very easy market to short. How about now? This is now. And maybe I'll zoom in now so that we can have a closer look. And it explains why, if you have had difficulty getting trades to work, this is an unusual and difficult setup. There's no question. I had a leverage long trade going into trading yesterday, which I immediately sold. And it could have made more if I let it run. But I also have a short position that I'm losing money on. And here's why. The reason I was both long and short is because I don't know which way this is going to go. It's been 5 for 4 or 5 days. That technically, that is a top because it has arrived there from a lower level. So it bottomed about at month end, which was also year end expirations. These have become very important dates. And then sentiment began to rise, but supply rose at the same time. And so the market didn't do well. Those are really difficult. They're not divergences. What do you call that? Right? It's divergences where demand is rising and supply is not, create great long opportunity. Convergences where demand is falling and supply is rising. I mean, I've made my all-time biggest dollar gain with a short position here. Because I could look at that and say, well, right into options expirations, there's a Fed meeting, demand is plunging, supply is rising. What's the probability that the market goes down? Well, pretty high, right? That one's easy. This is not easy. This is much more difficult. And when you look at the data and say, well, I'm not sure what to do, sometimes that's the best signal. It tells you, well, if you can't determine which direction the market's going to go, you're at higher risk. And sometimes the smartest decision, it's like the old cowboy saying that, what's the quickest way to double your money? Fold it over and put it back in your pocket. There are times for that. And, do I regret my short position? I don't know, but it's, certainly it's not working right now, because I would look at this and say demand has stopped rising and supply has continued to rise. This a couple of days ago, right? Options are expiring. There are some important data points coming out. I can't say for sure, but I would say that there is greater risk. And I did, I made money short in here. But, did I have any idea? Here's one of the core things I want to talk about. Could I have told you, looking at this data, that the PPI and CPI data points, which were not great, they weren't good. Be honest with the data. The trend in the inflation, trend in inflation at the wholesale and retail levels over the near term is rising. It's not falling. It's not great data. It's not data that says the Fed's going to cut rates. It's not true. So why did the market rise? Well, it gets back to the extreme importance of context, where these little green boxes are. Today, index options are expiring tomorrow. It's not a quad witch where the options and futures both for stocks and indexes are expiring. That's the name quad witch. I don't even know if there aren't a lot of single stock futures that I'm aware of. I don't know. It's something that has evolved over time. But that's a quad witch, happens 4 times a year, right, with the index rebalances. This is just a triple witch, is what we used to call it. Whatever you want to call it. Instruments that are used for leverage are resetting. And I would submit to you that the reason the market moved so dramatically on these data points has nothing to do with whether those data points are meaningful from a monetary perspective, but they had a big effect on the construction of baskets of options and futures about to reset that are used by folks using leveraged ETFs. I use them. We've got customers who use them. I'm going to talk a little bit about that too, about stops and limits. You have to keep in mind there are different volatility metrics for leveraged instruments, but they're massive. They are technically close to it, 20% of market cap. That is, only 80% of market cap ties back to the underlying equity. 20% of it is implied supply and demand in derivatives. And it's because it's strategies to generate yield from institutional portfolios by buying and selling volatility, that is buying or selling. So buy right strategies. Maybe many of you use those where you're buying equities and you're writing a put or call to produce a yield. Well, it's pervasive. It is a massive strategy. Well, what happens if something changes that? Well, it can have a real effect. If there were big bets just on a data point, will that be a tenth of a percentage point different in the monthly read in inflation? Whoever bet correctly forced the others on the other side to cover. And when you have to cover, you get called, and the markets explodes up. And it happens because of context. What is occurring right now? And people gravely underestimate the significance of those things. That's why I say, if you're not certain, if you're not willing to take some risk, skip these periods because you don't know which way the market's going to go. It could plunge, it could rise. You don't know because we can't see who won or lost. We do know the size of the bets. They're large. 20% of market cap. So one of the data points that we measure internally, if you go into a portfolio and you look over here, it's not in daily trading ideas because we condense it down. I don't believe it is anyway. But over here, you can see the key behavior. If I sort by key behavior, there are, to us, 4 big reasons that people buy and sell. There is characteristics. That's what passive money buys and sells. There are derivatives. That's risk management. There's price, which is dominated by high frequency traders, proprietary traders, Citadel, Hudson River Trading, Quant Labs, Susquehanna, Tower Research, Infinium, Optiver, GTS. I could go on. Right? DRW. They're not as big a player in equities anymore, but they consume all the data. They spend millions of dollars on data so that they're always ahead of you. They can see what the entire global book is in real time. In 220 markets, which way are things likely to go? And they're always ahead. Can't beat them. You can't beat them by trying to out-trade them. That's why most of the time, and I realize there are exceptions, most of the time technical signals don't work well because they're created by machines that are always ahead of you. That's why we say change of purpose and time horizon. You have to be a day longer than a machine. And then there is fourth, story. So we say story, characteristics, price, and derivatives. Those are the 4 big reasons people buy and sell. Right now, and these are 30-day reads, so it won't be real precise, but it tells you a general trend. There are machines dominating the pricing. There's no question that that's the case. And they know in the short term much more which way things are going to go. Their investment horizon is a day or less. That's why I like to say buy late in the day and trade, and then maybe I extend a day or two. I don't always, but then I'm past where machines have reset their positions. I talk about that all the time. But the moral of the story here is there is a tremendous weight from derivatives and they affect the market, and you have to be aware of that. So, if you want to keep track of the calendar, I'm going to go out here to the website. You can just click right through there from the platform and go out here to Market Structure Edge and look at resources, and let's look at the 2025 calendar. This is designed for public companies. We repurpose it here. In fact, it's we're doing some revisions right now to the 2026 calendar. But you can see 16th and 17th, market holiday Monday, increases the risk. Time is risk. Normally, new options trade on Mondays. So, it gets pushed to Tuesday. And then the 22nd, VIX expirations, volatility as an asset class resets. Well, I think these things are playing a very large role, which tells me I don't know what the market is going to do next. You would say with two dramatic, days that we've had, that the probability that demand or sentiment, market structure sentiment, is just an algorithm, 10-point algorithm. We normalize to 10 points, and we're consuming trade execution data to understand buy-sell movement based on those four big purposes. So could it rise? Well, sure it could. Or the market takes a serious hit again because these are very short-term strategies and it declines. I don't know. I wish I did. There are times when the signals are extremely clear and you can clearly see which side of the trade you need to be on. I'll go back here even. Early December, rising demand, falling supply, be long. The moment that it tops and supply begins to rise, now, certainly in your long-term portfolios, you could reduce your exposure to equity. If you're in your trading portfolios, now you're starting to think short, like I did. Took me a few days, but that's the very simple basis for these things. Now, I had notes from a number of you saying, I'm really struggling right now because I'm getting stopped out. And in one of you, I'll protect your anonymity. You might be here, but you said, I'm using these leveraged instruments on the S&P 500, and I'm putting my stops in 2-3% down. I'm getting stopped out. Remember, a leveraged instrument is going to be 1, 2, or 3 times more. So that you've got to account for that. So the SPY moves on average over the last 20 days, it's averaged 1.3% intraday volatility. It's quite a bit more than the 50-day average of 90 basis points. Call it 1%. You know that the tracking instruments like that, the broad market, the basket underpinning this instrument will move differently, but that broad instrument, 1%. So then the S&P 500, you look at the stocks, look at them. You could create a portfolio and look at their volatility. We provide it. 2%, might be 2.2%. So that's why we say you have to be willing to take risk of 2% because that is just the risk of beta, the performance of the market. So you want to stop that will account for that. But if you're using a leveraged instrument, say SPXL or SPXU, that moves 3 times, 200% more. Now your risk is 5-6%. So that's why you get stopped out at 2. You have not accounted for those moves. I don't like stops on leveraged plays because I only use them at inflection points in the market. If the market has rising demand and falling supply, I'm trading momentum. It's easy, it's predictable. I can take my 2%. I don't have to take as much risk as with a leveraged instrument. At inflection points, bottoms and tops, then you can lever. But realize those stops are not going to work because it's very unpredictable. We don't even know what the basket is that comprises those instruments, but it's not equities. It's synthetics. They're swaps, total return swaps. I don't know what's in it. There could be stock options and futures. There could be index options and futures. We don't know for sure. VIX securities, it's all mix of that, which is why they're difficult to peg. They're derivatives. So you have to realize they will behave differently. And I would caution, we don't give advice. We share our expertise on how the market works. We have a very profound understanding of the mechanics of the equity market and the behaviors in it. But you have to be careful about that. Those are the things that can catch you. Here, look, it's difficult. don't have a direction, right? Is it going to go up or down? Options are expiring. So just beware of that. Now, let me remind myself, I got one last thing I wanted to talk about. Broadly, I have said, well, I think the conditions in the market uh, could mean that we could enter a bear market. And you might say, well, Tim, what's the Dow gone up 1,000 points in a couple of days? I mean, is that the behavior of a bear market? So clearly your mind must have changed. I don't know. It's not the reason I proffered that notion is because there are numerous data points that I could point to. The sudden spikes in volatility, certainly there. Uh, you know, Rising prices don't capture much volatility because, again, we don't know what is in the basket comprising a leveraged volatility trade. It may have nothing to do with rising prices. It may have to do only with puts. So then when the market declines, you get a sharp rise in volatility. Number two is it's very difficult to get in and out of the marketplace. All stocks have a spread. There's the bid to buy and offer to sell. They will never be the same, right? So it's much easier to step up than to step down. That's why markets tend to have less volatility on the way up. Somebody will cross that spread. But the moment you try to get out, the spread widens. Who's going to cross it? And all of a sudden, volatility widens. That is what occurs. It's, again, basic. You have to understand, how does the stock market works? Well, it requires all things to trade at a single best price called the national best bid to buy or offer to sell. All right, so it's always going to be between those things. And so on the way up, they tighten. On the way down, they widen, and volatility increases. So you have to be aware of that risk. So have I changed my mind? All of these are characteristics of a changed market. I don't see any reason to conclude otherwise. If the conditions that would signal it go away, then fine, I will change my view. But if I look at the data, if I expand this out, what is this like? Well, this is more akin to a very rugged period in the market. That's all I'm saying. I look at this pattern. Is this pattern the kind of pattern that precedes a big bull market? No, it's not. You can go back and look at it historically. These are more bull conditions where you have a lot of green, where you have a lot of white space in there where you're breaking down, your demand is weakening. It's not great. Now, maybe somehow, for some reason, we will be off to the races again. I don't see it in the data. That's all. When the data indicates something else, I'll change my mind. I don't really care. I just want to look at the data, and hopefully the data will give me some reasonable ability to draw a clear conclusion from it. Okay, so that's what I've got, and the floor is open for discussion, please.
Couple of questions there, Tim. One from Rick and one from Joe, if you don't mind looking at those.
Absolutely. Okay, Rick. If market makers internalize some trades, blocks, large trades, do those trades still hit the time and sales that retail traders look at? Yes, I would, yes. I mean, everything gets rolled up into the consolidated tape, but what you and I are looking at is called the SIP, the Securities Information Processor. And it's currently one party. The NASDAQ runs that. The SEC approved. Did they approve? I think they're still being litigated. Proposals were made to open the market to competing SIP providers, but the SIP is always behind. So if we really wanted the best data, we would all go buy the two proprietary data feeds that every exchange platform sells. And the NYSE operates 5 of them. The NASDAQ operates 3. The CBOE operates 4, and there are 5 independents. So to have all of the data so we would actually know what's occurring, we would have to buy 30-some different data feeds. That's what Citadel does. So where all that stuff goes, who knows? I mean, I have it happen to me all the time. If I trade in any kind of size, several thousand shares, you go look at your trades, it got splattered all over. Some of those are 5 shares, 20, 199, 78. How's that happening? Well, those are all algorithms that are intermediating. Everything's arriving, bam, right in the center of the bid and the offer, and it gets sprayed about. Well, it's very difficult all other things being equal, to know which way things are going to go. That's why I say we have to have a clear picture of supply and demand. If we do not, it's very difficult. Right now, the appearance of supply and demand is muddled. Uh, I agree. I mean, the volume data is correct by the end of the day. The reason our data don't post until about, call it, all the way through. So we get data, we process the data by about 11:30 p.m. Mountain Time, 1:30 a.m. Eastern Time. By 3:30, we have applied all of our algorithms to that data and processed and posted conclusions. The reason that takes so long is because it takes a long time to sort through all that volume. That's coming from the exchanges, right? And there's so much created volume. When you look at 49% of market volume is short, that means it's created. I was telling a company today, public company customer of ours, I said, if the reason you are down 11% year to date is only two things. Machines are up 5%, your short volume's up 15%. They're just making up stock and trading it. It has nothing to do with your owners. It's a really difficult thing for public companies because you can't do anything about it. Right? Is a good place to track the average volatility of the SPY. Well, we calculate it, but I don't think we post that, do we, Brian? You can look at SPY here. What you could do, you can, any data source that gives you open, high, low, close. We buy data from Quote Media, but any source that would give you high, low, close will give you everything you need. The high and the low spread divided is volatility. Then run an average because, one day is not a pattern or trend. We use a 5-day rolling average. So to track FTDs. Well, if you look at the FTDs that fails to deliver, if you look at the fails to deliver data, it is interesting. Most of the fails to deliver resolve before they end up on those threshold lists. Right? They happen. We have a big corporate customer who's a big money manager who told us they've had billion-dollar fails to deliver in SPY, the single most liquid security in the U.S. equity market. So it can happen. Those FTD lists tend to be illiquid or ETFs. They're 80% ETFs. So good. Joe? Okay, let me see if I've answered your question. Good place to try and similar components, see when it's high. Well, and we're doing that. I mean, here's a good way to do that. If you want to look at how is volatility changing over time in any portfolio, you could do this at the Edge dashboard. So, if I wanted to look at short, let's take the 75% short, which has come down, by the way, from about 50 to 42. What if I just wanted to know stocks that are heavily short, is volatility increasing or decreasing in that group? Now, you'd have to take points in time. Could we make this easier? Yeah, maybe we will at some point. But you can export this to Excel and very quickly look at and you might have to then, do this once a week and look at the trend. But you could very quickly see, is volatility in things people are shorting or that have high levels of it increasing or decreasing, and just run a calculation, right? You could do an average of volatility. It's averaging 3.3%. So, that's effectively 50% greater than the broad market. Now you could look at that in a short portfolio over time, and if it's increasing, the amount of shorting is probably increasing too. Because again, remember the spread. Getting out causes the spread to widen. Getting in causes it to tighten. Generally, you can't see my screen, can you? Here, let me do that again. So what I did here. Back to the platform. I just went here. I exported this to Excel. So I'm in this short portfolio, 75% short. It's one of mine. I just set it up and I look for stocks that are with some liquidity characteristics that are 75% shorter or more. Export it to Excel. Go over here, calculate the average volatility, in that group. And it's 3.3%. Well, if the S&P 500 is 2.2, it's about 50% larger. So you could take a benchmark of that. Is it increasing? Well, that may tell you have a stronger play on the short side. Widening volatility tends to mean money's trying to get out. Not always, but as a general rule, that's true. Okay. About at it, we got 3 minutes. Well, okay, so providing it on other markets, the reason we're experts on regulation national market system. I provided written testimony to Congress in 2017 to the House Financial Services Committee on ways to improve the market for issuers and investors because we're experts on Reg and MS, and it has a defined mathematical data set. Global markets have all been seasoned with the influence of our maker-taker model, where exchanges pay traders to sell stock, to provide liquidity, and charge people to take it away. So institutions need it, short-term traders don't. So short-term traders manufacture liquidity, and long-term investors consume it. And so the exchange will charge the people who consume it and pay the people who provide it, unless it's an inverted market like the PHLX, a NASDAQ market. There, they will charge you to provide liquidity and pay you to take it away. Why would they do that? To set the bid and the offer. Then they have the best price in the market and orders have to come to them. But the point is, global markets have different data sets. I mean, Canadian market, we could do. Europe, challenging. So much of the European market is off exchange. Over half of ours is currently. So that's why we have it. Okay, 2 minutes left. Brian, anybody have how can we use those 2 minutes to best effect? Me not talking would be one easy way to get there.
Well, I've got one for you.
Okay, Barry, glad to hear it.
Yeah, so I think CVNA is a classic stock to watch to see how market structure tea leaves kind of drive the stock. Short volume on CVNA is at a 3-year high at 72.4.
Okay.
That's a 3-year high.
Wow.
It's up 30% since January 3rd. It's been on a roll. Yes, Hindenburg did a hit piece on it that there's some questionable internal loan practices. Maybe that's true, maybe that's not. But the way the stock has reacted and the way short volume has just gone through the roof, I think it's a fascinating candidate to see how it responds with you've got expiration taking place. You've got short volume at an all-time high and it's run 30%.
Wow. Yeah. So what is occurring is supply is the holders aren't selling. So supply is being manufactured to fill orders that lift the price 30%. The question is what happens from that? You're right. By the way, Hindenburg, they announced yesterday they're shutting down. It is so difficult to short in this market. Andrew left. Classic short. He's under investigation and getting sued. It's the shorts are all. It's really so you're like you're going to be the lone gunman pretty soon, Barry Norton, because it is you really have to know what you're doing, and those guys don't know market structure. To me, that's why they have failed. They don't understand the mechanics of the market. They don't understand that market makers are exempt from Reg SHO Rule 203(b)(2). They can create stock. But you're right. Does that cause a sudden violent mean reversion? Don't know. Yeah.
But it'll be interesting to watch.
It will. It will.
And that's my point. I just say Hindenburg just because, okay, they were out. But yeah, their track record is terrible. But it's just a fascinating dynamic I've just been watching it. The options are too volatile and the stock itself has done nothing but gone up. But as I look at the, microstructure tea leaves, it just says, you know what, next week, it's going to be interesting to see what this puppy does.
That's a very good point. That's a very good point. So Carvana, CVNA, let's see what happens. We'll benchmark that next week, Barry. Now it's 111. Now we have to let you go. And the markets are closed Monday. We'll still do a market desk note, but we'll do this again Thursday, whatever that day will be. 23rd? I think that's right.
23rd. Yep.
Okay. You all enjoy the long holiday weekend. We will. Snow conditions are awesome. I was out there. Yes. Don't tell. But the snow is really great here in Steamboat. All right. Good to see everybody. Thank you. Thank you, Barry.
See you guys.